If you've saved for retirement in an IRA, 401k, or other tax-deferred vehicle, you've made a bet that your taxes in retirement will be lower than they are today. But will that be true? We simply don't know. Here are 3 ways that your taxes could be higher in retirement than they are today, and what you can do to help mitigate that risk. Number 1, your tax bracket could change. Now, for savers like you and me today, our tax bracket rates are being held at artificially low levels, thanks to the 2017 federal tax reform, sometimes called the Trump tax cuts. But what we have to remember is that those tax cuts expire in 2025, which means that in 2026, all of our federal income tax bracket rates are reverting to their older, higher rates where they were before the reform. That means even if your income doesn't change in the future, you may be in a different bracket, and that means more of your income may be sent to the IRS in Washington, and less of it will you have to spend in retirement. Now, brackets are the most common way we think about taxes changing in retirement, but they're not the only way. Another way your taxes could rise is by loss of deductions. If you make $100,000 a year and you can deduct $20,000, you pay taxes on $80,000 of taxable income. Well, what if next year Congress changes the rules? What if now you can only deduct $10,000? Suddenly, you're paying taxes on $90,000 of taxable income. Did your bracket change? It didn't. But do you end up with less income to spend because you're spending more in taxes? Absolutely. The third way that taxes could change for you in retirement is if Congress were to change what is taxed, when it's taxed, and at what level it is taxed. A great example of this is Social Security. Now, you may know that currently your Social Security benefit is taxable up to 85% of that benefit. But it hasn't always been that way, and it doesn't always have to be that way. Congress could pass new legislation making 100% of your Social Security benefit subject to taxation. Again, your tax bracket didn't change. You didn't necessarily lose any deductions, but suddenly you have less income to spend in retirement because you're sending more of it to the IRS in Washington, D.C. in the form of taxes. Now, is your retirement approach protected from the risk of rising taxes? It's an important conversation to have with your financial professional. Your future self will thank you if you understand and prepare for the risk of rising taxes today.